A very warm good afternoon to everyone, and welcome to the second webinar in our KSA Transfer Pricing series, hosted by Hundt Partners, Legal and Business Advisory, and GTPN. We sincerely appreciate your time and participation today. Following our first webinar, which is focused on KSA Transfer Pricing overview and regulatory framework, today's session transitions from framework more into the implementation. This is a technical deep dive into audit-sensitive and high-risk areas, including intangibles, intergroup financing, regional headquarters setup, SEZ, which is special economic zone dealings, PE, profit attribution, and industry-specific transfer pricing challenges. Transfer pricing in Saudi Arabia has clearly, from the last 5 years, we have seen the transition, and today we wanted to give you more insights into specifics on each of these industries as well. At the outset, I would like to introduce our keynote speaker, Mr. Hundt, for hosting this session. And with over 27 years of legal and business advisory experience in Saudi Arabia, Mr. Hundt brings in deep expertise in legal regulatory framework, structuring, and cross-border commercial matters within the kingdom. Along with him, we are pleased to have three highly experienced speakers in today's discussion from GTPN, which is Stefan Siedel, economist and business strategy advisor who brings over 25 years of international experience across economic strategy, commercial deal structuring, investment advisory, and portfolio management. Having held leadership roles at institutions like Chevron, ADNOC, and Qatar Petroleum, he provides a macroeconomic and commercial lens to value creation and cross-border structuring. Next, Mr. Sarma Jaffer, business valuation advisor, is a recognized authority in intercompany financial transactions, hybrid instruments, intellectual property valuations, and treasury policy design. With nearly 2 decades of experience across North America and the Middle East, he brings in outlook into the local nuances, also in terms of understanding the local business valuations. Next, we have Mr. Praneeth Narahari, who is Global Transfer Pricing and Structuring Advisory Leader, who brings over 15 years of close experience in terms of APAC and Middle East market, leading complex structuring, pillar to advisory, dispute management assignments across more than 30 jurisdictions. Together, they bring in economic outlook, valuation techniques, and technical transfer pricing depth in these discussions. Before we begin, we have few housekeeping points. The session will run approximately for 1 hour, and it's structured as a technical interactive discussion. We encourage participants to submit questions throughout the Q&A function during the session. We will address them either during the relevant segments or consolidate them towards the end. And this session is recorded for circulation purposes. Without any further ado, I would like to take this opportunity to ask Mr. Hundt to provide some current tax outlook from Saudi perspective. Mr. Hundt, the floor is yours.
Thank you, Mr. Hundt. So nice to be back with all of you. Great colleagues, also to have Mr. Stefan Seidel here with us, and Mr. Salman and Mr. Praneeth, of course, and we are very much excited to get into this deep dive after the first webinar, which was very much of a success, and in which you provided all this great overview of how TP is at the very core of tax sophistication and tax risk management in Saudi Arabia, and also especially under the Vision 2030. And obviously, I'm very much excited to hear what you're going to say today in the field, specifically of regional headquarters, which is very much a flagship in Saudi Arabia, and the new special economic zones, as we see here on the screen, which is very much my field of expertise. And I will not waste more of words, I would say, because we want to hear the details. We're going to get the real deep dive, and maybe at the very end we can have a small outlook on what the future might bring in TP in Saudi Arabia. So thank you very much, and looking forward.
Thank you for that, Hundt. I think Just to set the broader macroeconomic context, I would like to leave a floor to our economist, Mr. Stefan, who can provide a brief economic outlook on the kingdom. Stefan, the floor is yours.
Hi, Anand. Thank you very much. So just on a very high level, the transformative Vision 2030 is such a transformative, impactful change in the Kingdom of Saudi Arabia. You'll see that in all areas of business, both on the oil side and increasingly in private sector investments outside oil. The private sector activity is increasing significantly. You see that especially after Corona. The last 5 years, just in every dimension, you'll see that the excitement, movements, both from a venture capital on a very small scale, as well as PIF investing and bringing in large corporations. Diversification away from oil, you're over 50% now on the GDP side, non-oil related, which is a transformative step. The value chain is definitely a significant upgrade. You see that across the organization's skill levels. That has a big impact on the valuation side. The business models are changing. You go from a very government-mandated, structured, top-down approach to a much more dynamic whole. We see that across the GCC. Obviously, UAE is at the forefront of that, but Saudi is picking up and catching up very quickly. One of the two topics which was mentioned, headquarters, these special economic zones, AI, data center, a big push, which is both on the technology side, but then also power is obviously very important. So you see a lot of investments in either renewable power, green power, or gas-fired power stations. So just a push across the whole value chain, moving away from pure oil and gas export to a much more integrated system, brings employment opportunities for local talent. Headquarters was the second topic, brings in external expertise, upscaling is happening, just a diversification and growth of the society, of the industry, which is just unprecedented, really. And last point is then all of that then impacts the tax picture, both from a in-country taxation as well as a cross-border taxation.
Yeah, thank you, Stefan. I think that set the right context. I think we wanted to dive into the more technicals now. I would leave the floor to Mr. Sarmad to take on the intangibles. Sarmad, the floor is yours.
Buddy, and thank you all for joining us. It's a great privilege for us to have you here. So we have quite a lot of elements to discuss as part of this. But we're starting off with intangibles, and I think that's by design because, as Stefan had mentioned, there is a great sort of wind of change that is sort of flowing across the desert, right? And as part of that Vision 2030 plan and the special economic zones, you are seeing really, Saudi economy diversifying and a lot of new industries coming into play. So you are seeing this transition from basically a traditional energy economy to a knowledge economy because a lot of it will be centered around AI and obviously data centers being a big sort of driving the whole ecosystem that will come of it. So intangibles are very important to that because as traditionally what you see is as economies become more knowledge-based economies, intangibles tend to play a bigger and bigger role in the value creation of the companies, right? And this is a trend that we're going to see in Saudi Arabia, right, as new industries take root. Now, I'm just going to give you a brief overview of what intangibles are, right? So how do we actually think about intangibles, right? So essentially, as the name suggests, intangibles are something that are not physical assets, but neither are they financial assets. But they're something that a company can control and through these intangibles, it is able to create greater value across its value chain, right? So the intangibles, I mean, there's not necessarily the case that there's only one intangible. There's intangibles also encompass intellectual property, which means trademarks and trade names. It can also mean patents, but it can also mean internal know-how and processes that are proprietary and allow a company to execute, its product manufacturing strategy more effectively, right? So anything that basically helps distinguish its products from its competitors, right? You can see them, you can observe its impression across the value chain, like what we have here shown in the exhibit, where you have a chain of activities, and you have the marketing and sales factor being more touched with intangibles, and through that function creating greater recognition for products, for example, through branding, and that allows the company to actually create additional value by being able to increase their revenues, so on and so. So generally, intangibles affect the revenues or the costs, right? And they can affect the revenues through higher quality, good brand recognition for the customers, or improvement in the processes that allows them to produce at a lower cost. So essentially, in a nutshell, that's what intangibles are. They're not just intellectual property. They're very, very ubiquitous. And especially as businesses get more complex, you see that there will be intangibles all across the value chain, and it becomes very important as part of your transfer pricing strategy to understand exactly which intangibles are and where these intangibles are being created to create effective transfer pricing policies. So with that, I know we have a lot to cover. I'll hand it back to Anand. Thank you, guys.
Thanks, Salvat, for setting the stage. I think one interesting that you can see it on the screen is the case of missing intangibles. And often the clients always say, we don't have it in our balance sheet, so we don't have to deal with it. I think it's also something that is important. And then these discussions with our clients and also with the tax authority, it's not about the show up there, but if there's a value added that you can clearly see an impact on the profitability, and a clear analysis needs to be done. Moving on to the next important topic, transfer pricing considerations for regional headquarters. I would leave my colleague Praneeth to take it over. Praneeth.
Thanks, Anand. Good afternoon, everyone, for joining in. I think Mr. Stefan, Hundt, and Sarmad have set the context and given enough brief as to why there is RHQ and SEZ framework in overall build up towards Vision 2030 initiatives. To put it in a nutshell, I think Saudi wants to shift from mere market presence to control presence in form of RHQs, and also play a key role across the supply chain in terms of SEZ framework, thereby creating that in-country value that Stefan has highlighted. So I'll briefly touch upon the RHQ framework. Again, I'll focus on the TP considerations, which is the core of our session. If you see on the left side, the RHQ framework mandates you to have a separate legal presence to host these RHQ activities. And then there are mandatory activities in terms of strategic and management functions. And then there are optional activities in which you have to at least do 3 of the entire exhaustive list, which is given. Then, of course, the crux of entire thing is to maintain substance, to claim the tax incentives in terms of 30-year 0% tax rate or zero withholding, and other employee or people related beneficial framework which is there in the RHQ framework. So if you see the substance based regulations which are recently released, what they highlight is you should have enough people, you should have proper office presence, and also the central management or key strategic decision making has to be driven out of these RHQs, and also have enough operating expenses. So all in all, RHQ has substance in terms of costs and services driven out of kingdom. Now, the important aspects which comes into play is how do you remunerate for this overall support functions that RHQ is providing to M&E as a whole. That's where the transfer pricing principles laid out in the KSA TP guidelines and bylaws, along with the OECD guidelines, especially on intra-group services, because I would see the entire framework of intra-group services being intrinsic to the overall RHQ remuneration mechanism. So if you see the middle box, I would split that into three baskets. One is pass-through or shareholder activities, which doesn't require any remuneration. The second is the value-added segment. Again, there are two subsets. One is low value-adding activities and then high value-adding activities. On the first part, which are pass-through costs, this could mostly be in the nature of your shareholder activities, which are done as part of overall group corporate governance and compliance obligations, which are benefiting all the group entities as a whole. So the cost should be borne by the ultimate parent entity and not by RHQs or the subsidiaries, because those are done in the interest of shareholders. So these are the pass-through or cost-to-cost basket, wherein RHQ has to push up this cost to the UPE of the MNE. Then you have the value-adding activities, which is the interesting basket. So you'll have to view it in two subsets. One is the low value adding, be it your routine admin and business support functions, which are not core to your overall operations. These fall under this basket. As we all know, cost plus 5% is general mechanism which is adopted. But there is an interesting aspect or element here. There is no explicit mention of this simplified approach or safe harbor in the KSA TP bylaws. But again, since KSA follows the overall OECD framework, we can refer back and leverage the simplified approach being provided for low value added services in the OECD TP guidelines. So that's on the low value added services. Second comes the high value. So obviously, whatever activities in terms of strategic, managerial, or market functions that these people do in the RHQs doesn't only warrant a simple baseline return in terms of cost plus. There has to be a residual from the group consolidated profits that have to be attributed to the RHQ for these high value added functions. So the bottom line is, for high value added activities, you can't go with default cost plus approach. You'll have to well into other methods like profit split, or maybe use cost plus and then add additional layer to attribute the residual return for the high value added services. So this is on the remuneration mechanism piece. And then last segment, if you see on the right leg, comes the overall TP checkpoints. One important thing is the business restructuring aspect. As we highlighted in earlier session, we have to disclose. There's a specific disclosure on business restructurings in the TP disclosure form. Okay. Most likely, whenever you set up an RHQ, it would entail reallocation of roles and responsibilities and people from the existing group entities within the MNE group to the RHQ setup. So thereby there is a potential impact on expected future profit outflow for the entities which are foregoing these roles and responsibilities. That's where we have to see whether that impact on profit outflows would warrant a arm's length compensation. It could be in terms of exit charge or valuation techniques, which Sarmad and Stefan will well in the ensuing slides. So I leave it there on the business restructuring, and then other important housekeeping aspects or the cost pooling and allocation, and have appropriate cost drivers to see wherever you can identify the direct allocable costs, and an indirect costs have to be apportioned based on the appropriate cost drivers. An important aspect is what part of the cost or what nature of cost should go into the cost base for TP remuneration or invoicing purpose is a key aspect. And then segmentation is other important aspect, because the 0% tax incentives is available only for the eligible activities. So that's why it's important to draw a fine line in terms of costs and revenue splits, to have separate segmented P&L for both eligible and non-eligible activities, because non-eligible activities will follow the regular tax regime as per the income tax law. Then we also have to see from the beneficiary perspective, because whatever we have discussed now is from the service provider perspective as to what should be the ideal remuneration for the underlying activities that they are doing for MNE group across the supply chain. But it's also important to understand from the beneficiary group entity perspective, who are receiving these services and making a payout, because deductibility becomes a key. In addition to LP tests, this so-called benefit tests, which got incorporated into overall TP framework, I would say it's more of a deductibility aspect or a tax aspect. But now, recently also we had a rounds of discussion with the OECD team. They are bringing out a separate chapter in the latest update of the OECD guideline on the benefit test, where they will give clear do's and don'ts for the taxpayers and MNEs as to what are the aspects that you have to tick in the checklist to ensure that you're meeting this benefit test from a beneficiary standpoint. And of course, last comes the overall transferring obligations. It's important that even the RHQs follow, because there is an explicit mention that the TP bylaws are also applicable for RHQs. So have a proper policy documentation, intercompany agreements for RHQ activities, and also tick all the compliance obligations in terms of TP disclosure form, local file, master file. And importantly, in master file, you capture these intra-group service arrangements clearly that are emanating from the RHQ activities. So this is to sum up on the RHQ. I'll just take just a couple of minutes on the SEZ, which is in the next slide.
Right.
Yeah.
Right. Just before we push into it, thanks for this comprehensive coverage. I think the OECD draft chapter, hopefully for discussion, should come by July. And then hopefully this year we should be able to have a bit of an idea how that's going to apply. And then probably that will have impact on the documentations that a multinational needs to prepare. Yeah. And you're a couple of minutes, Praneeth, on the SEZ.
So it'll be exciting times ahead once we get this chapter, updated chapter on intra-group services. Now on the SEZ, as Stefan slightly touched upon, reducing the oil dependency and then being a more diversified jurisdiction. So KSA also introduced latest 2026 SEZ framework, wherein it brought in four special economic zones with specific industry focus, or clusters, I would call. As you can see on the left leg, you have KAC, RAG, ZAN, and more importantly, the cloud computing to draw the digital data centers and cloud capabilities into the kingdom. There's a lot of investment flows expected from the foreign investors over the next 4 years as we move into 2030. Now here, again, everyone would be curious as to why we have brought in this SEZ within the TP framework, while there is no explicit mention of any transpricing checkpoints or obligations for SEZ as such. But one important thing, wherever we are dealing, where there are intra-group dealings with these SEZ entities, obviously there is scope for tax planning or profit shifting or in-country tax-based erosion. That's where TP plays a pivot role. So this slide is to throw some light on checkpoints that we have to be aware, so that we are ticking all the boxes on the substance requirement, at the same time ensuring that our transactions with SEZ entities are meeting the ALP test. Okay, so that there is no clawback on the incentives that we are getting even after meeting the substance requirements and other mandatory aspects which are mentioned in the SEZ framework. Now, in terms of TP checkpoints, I would say that the intent should not be to concentrate or park all the profits in SEZ. Okay, the first step is to see what is the substance in terms of people, premises, expenses, assets which are required. That again, we can fall back on TP framework in terms of FOR analysis based on the underlying economic activity, and see what is the relative substance which is required for the specific activities. Ensure that whatever intra-group dealings that we are doing with SEZ and entities follows the TP principles and the ALP test. Just because there is no tax, okay, it doesn't mean that you can deal with this SEZ entity in whatever way or manner you want. There is additional dents, I would say, wherever there is a tax incentives given to strictly follow the TP principles in terms of year-end compliance obligations, the segmentation between eligible and non-eligible activities, the TP policy framework, and then your supporting documentation. So this is what I just want to briefly touch upon the SEZ and the intra-group dealings and the TP importance in the entire framework. Over to you, Anand. Yeah.
Thanks, Praneeth. That's a comprehensive coverage. Anyway, we'll share these slides as well to everyone so that to get to read all of that information. And I think the one thing that cut across all the multinationals, especially, is funding. And then, when we deal with clients, this is one of the most requested topic. So we're leaving it to Sarmad, our experienced financial transfer pricing advisor, to take it over.
Hello again. So I'm going to switch hats here and put on my banker hat to deal with what we call financial transactions. So I'm going to basically summarize financial transaction relates to the transfer pricing analysis of intercompany loans and guarantees primarily. We see a lot of instances, with our clients where you have advances that are sitting between companies and they've not been, it's kind of the nature is a little bit abstract because, for accounting purposes, they're considered to be loans. But, there isn't an actual form. There isn't, any terms around it, repayment terms or interest rate terms. A lot of times you have advances that are not, accumulating any interest. And, clients tend to think that if you haven't really introduced an interest, then you haven't, invoked the requirement for, the necessary analysis for the intercompany loans. This is not the case. Even in instances when you do have intercompany loans and there are interest-bearing loans, there needs to be a case that needs to be made before you can even analyze what the interest rate is. The case being whether the debt itself is bona fide debt. Now, what are the factors that would support a debt as being bona fide? One of them is legal form. So if you have, any sort of term sheet that outlines essentially, the terms of the loan, including the interest rate and the repayment date and security and so on and so forth, that's good evidence that something, is a loan in form and in substance. But besides that, I mean, what a lot of people miss is that there has to be an actual purpose to the loan. You cannot just, pass funds onto a different company and it's sitting there and it's not being utilized for any business purposes and you're calling it a loan and using that as an instrument to basically draw out interest income in a different jurisdiction. That is certainly not allowed because there is a very strict criteria and discipline that needs to be followed for a intercompany loan to be actually respected as a loan before you even get to the analysis of the interest rate. Now, getting to the analysis of the interest rate, there are a number of variables, one of them being the credit rating analysis, which is where you're assessing basically, the credit risk of the borrower, the intercompany borrower. And, Zatka said something very interesting in their guidance about this, that if you have a credit rating outcome that is indicating a very high risk, borrower, that actually feeds into the idea whether this loan is a loan in the first place, right? Because lenders tend to be risk averse by the nature of the investments that they make. So, if you're dealing with a credit risk profile that is, too speculative, then that sort of plays into the first question, which is whether this is bona fide or not. So there are a lot of little moving parts that kind of feed into each other that people need to be aware of. The second, situation that you see a lot is that of corporate guarantee. So this is not uncommon where you have a large parent company that is basically providing guarantees to its subsidiaries with their local banks so that, the banks feel comfortable in, opening lines of credit for these subsidiaries. And generally, the arm's length standard says that nothing is for free, right? That's a economic principle that is also true in the transfer pricing world. So if somebody is conferring to me this benefit and I'm to treat them as an arm's length person, then nobody would be that gracious to give me a guarantee for free, and for that reason, some consideration is owed. Right? But that question of consideration depends on the benefit that the guarantee actually creates for the recipient, right? In a lot of cases, you have equal sized recipients that give cross guarantees as part of a global sort of banking relationship. And in that situation, there isn't there isn't a clear answer of whether benefit is being utilized by one party, right? Because everybody's contributing to this guarantee pool, and out of that, everybody benefits, right? So for a guarantee fee to actually apply, for there to be a case that there is a guarantee fee owed, you need to demonstrate that there is a tangible benefit that is created for the guarantee recipient by way of a lower interest rate, right? And that lower interest rate then commands the payment of a guarantee fee, right? So that's essentially what a guarantee fee analysis entails. And again, it's not always clear whether a guarantee fee is owed. So you need to work through some discipline in terms of identifying the benefit and then making a case for a guarantee fee to apply. Okay. So with that, I will pass it back to Anand.
Thank you, Samad, for that. I think, again, the next most litigated and always controversial across the globe is profit attribution to PEs. So I would leave that specific topic to Pranit. Pranit, here, please take it away.
Thanks, Anand. So, in a typical PE risk assessment, it entails two-phase analysis. First stage, you do the PE risk assessment. We have to look at the domestic law and see if there is a fixed place PE, service PE, agency PE, or a project PE. And then you look at any tax treaty benefit which is available where you can take shelter. And then at the end of this PE tax risk assessment, if you see that there is a PE risk being crystallized, the tangible exposure, then you go to the next phase, which is the profit attribution, so that you offer relative profits to tax in the kingdom. This is where I'll focus, which is the profit attribution to PE, because KSA advocates use of separate entity approach, which is arm's length principles for determining the attribution of profits to the PE in the kingdom. Now, again, I just want to touch upon the other alternative before dwelling deep into the separate entity approach, which is the deemed profit regime. Wherever there are no books of accounts maintained, there is this presumptive profit framework which is available to the taxpayer. Again, it's not by default. You should make an application and then it is contingent upon the approval from ZATCA. But generally, the taxpayers don't tend to fall back on this alternative because the presumptive rates are ranging from 10 to 85%. Generally, 40% and above is what is being approved by ZATCA. So if you look at the end product, which is the ETR burden is high if you follow the formula-based deemed profit regime. That's where the taxpayers rely on a FAR-based approach, which is your ALP principles or separate entity approach when you do the profit attribution, because there the ETR burden is directly dependent on the underlying substance and the value that is created by the PE in the kingdom. Now, on the separate entity approach, it's a two-step analysis. First step is you have to view this PE as a hypothetical legal entity and see what are the functions, assets, and risks that are borne by the PE relative to the roles and contributions of the other group entities in the supply chain based on the significant people functions, I would say. So based on this FAR analysis, then you move into the ALP or remuneration mechanism using the TP methods and the TP models which are there. So again, once it's open to use any of the TP methods based on the underlying FAR. Typically, cost plus method is used in a service scenario, and then you have to see other methods like profit split if it is a project PE, and then you can use a commission model if it is an agency PE. So this hypothetical legal entity is viewed as any other independent party when you are determining the profits that you have to attribute to the PE. So this is on the separate entity approach. Bottom line is from a tax impact standpoint, SEA approach is preferred because that will have relatively lesser ETR burden when compared to the deemed profit regime, because it's scored to the underlying substance and value that is created by the PE. And then you can offer profits to tax based on the underlying substance. Over to you, Anand. Yeah.
Thank you, Pranit. I think the next topic is the most topical one, considering the April 30 deadline that we are coming. And then most of the clients always, who are trying to close their books, they always have these questions. what is an adjustment, first of all, and then everyone says auditors are not accepting these adjustments, or can we do these kind of adjustments? And then generally the two questions that comes in is whether can we do it before the books, closure of the books, after the closure of the books. If we get audited, is even the adjustment is okay? So I think the best time for us to probably dwell next few minutes on this topic, just to give them an idea what's happening right now.
Thanks, Anand. Thanks for setting the context, especially on the timing of these adjustments, because that's a critical aspect. If you see the timeline, which is there on the left side, you have proactive options, and then there's a reactive scenario. In terms of a proactive or ideal scenario, I would say that it is highly recommendatory to ensure that you are adhering to the group level TP policy before closure of books, and your financials are signed off by the auditor and management, because there is no crystallized primary or corresponding adjustment at this juncture. It's more of audit entry or accounting adjustments before your books are closed. So you will not have any additional tax impact or interest penalties when you ensure that your books are aligned to the underlying TP policy, group level TP policy that you have said. So one important recommendation is, considering the deadline fast approaching, which is April 30th, you look at your provisional financials and see a transaction wise TP policy which is there. Ensure that your actual outcomes are aligned to the TP policies, and wherever required, you do necessary true up adjustments. Because before closure of books, you can do both upward and downward adjustment, but any negative adjustments will become tricky when after the closure of the books. So you have open plate to do all this housekeeping stuff if you proactively react and then take these necessary actions before the closure, and then it will lead into seamless year-end transparency compliance obligations. So this is on the first step, which is the closure of the books. And then the second step is, if you miss the bus, okay, you have second opportunity, okay, to look at your actual outcomes and the ALP range or the TP policy, and whatever is the differential which is required to be adjusted to ensure adherence to the TP policy. That can be suo motu or voluntary offered in your tax return. It will go into a statement date. But the thing is, of course, this could be a audit trigger point because there is a separate disclosure on voluntary adjustments that you do. But again, having said that, while we have missed the bus, still it's a good juncture to clean up and ensure seamless compliance rather than leaving it to that cup and then expose ourselves to the audit. So second is at the time of filing your tax return, and then last comes your TP audit. Of course, if you have ticked all the boxes in terms of ALP test and overall compliance obligations, there could be less exposure to transparency audit. I think in the next slide we'll touch upon the basics as well as industry specific checkpoints that we have to be aware of. But again, if there is an audit, there is a scope of adjustment, especially if ZATCA feels that your actual outcomes are falling below or above the range based on whether it's inflow or outflow into the kingdom. There is a concept of this corresponding adjustment where there's a adjustment made in another jurisdiction, okay, because of your cross-border dealings. ZATCA might allow the flip side adjustment in the kingdom to avoid scenario of double taxation. Of course, it depends. It is contingent upon you filing application with full transparent disclosure of all the details, and then they will do their ALP assessment, and then only upon approval you get this corresponding adjustment. Where if you fail in that procedure, of course, we can invoke MAP on the other side and ensure that there is no scenario of double taxation because of this transfer pricing adjustment. To sum up, I would say, since April 30th deadline is fast approaching, it's important to look at the provisionals and do necessary year-end auditor accounting adjustments so that your actual outcomes based on the numbers that are going to your financial before sign off, or adhering to the overall transfer pricing policies that you have set at a group level, and then take it on from there to TP disclosure form, local file, master file, and the CBCR compliance as part of your year-end TP compliance obligation package. Yeah, that's it from my
Thank,
end.
no,
Yeah.
no, thank you, Pranit. I think if I have to sum it up, it's proactive than reactive. So I think proactive is the most important. Next topic, I think again the most requested topic, even after our first presentation. I think the number of mails that we have received always requested on intangibles, especially on the valuation techniques. Considering the fact that Jatka is one of the, I would say in the Middle East, if there is any transfer pricing guidance, especially on the valuation techniques, I would say KSA is the first one to do. So I would leave the floor to Sarmad and Stefan to talk about both from a transfer pricing perspective, also from their experience on the business side as well. Leaving the floor to Sarmad first and then followed by Stefan. To you
Thank
guys.
you, Anand. So just, switching gears or actually, coming back to where we started, which is the question of intangibles. So now we're going to be talking about valuation techniques, and this is only relevant when you're dealing with the migration of intangibles, especially as part of a restructuring involving the centralization of certain key people and intangibles, in the HQ. So those are situations where this might come up, right? Where you're sort of shifting intangibles, trademarks, trade names, know-how, etc., from one company to another. Okay, so there are generally, many, accepted concepts about valuing intangibles depending on the type of intangible that you're dealing with, right? But generally, valuation techniques fall into either an income-based method, which is basically you're able to identify a cash flow attached to a particular intangible asset and then discount it down to come up with the present value, and that's the income method. The second bucket deals with basically the cost of replicating this intangible, if that is even possible. In some cases, it is. When you're dealing with software code, for example, you can usually rebuild it a certain period of time. And that also gives you some proxy for what this software is worth based on the cost of recreating it. And finally, there is instances when you have, comparable transactions that have happened in the market of similar intellectual property that you can use. And this is called the relative value method, where you can just point to transaction prices that have happened in the market for, similar, underlying intangible software, whatever it is. Right now, I would say just the nature of intellectual property, the nature of intangible means that whatever you're dealing with is unique by design, which means that this relative value method gets applied less and less in practice. Right. So generally it's either, some type of income approach or, some type of cost replication approach. Now, the ZATCA has you come out and actually, again, it's good that they have actually dabbled with this issue, which, people, don't really focus on, but, they've given some guidance and they've acknowledged the use of, income method, which is the discounted cash flow method, and they've given some guidance around that. But they've also given some broader guidance in terms of, how you look at a particular exchange in the broader context of the exchange, right? For example, so let me explain. When you have a shifting or a sale of intangible from party A to party B, there's a certain price that you come up with based on the valuation techniques that you employ. But there is also an economic case, right? So, for example, deals only happen when something is of more value to party B than it is to party A, right? And they come up with a price that basically effectively is the equilibrium where both of them are in a net surplus situation, right? From the acquisition of the said asset. Right. And ZATCA has deliberately raised this point that when you're establishing a price for, the migration of intangibles, you need to consider that you are actually there's actually the price that is being paid to the seller is more than the internal utility of, that said intangible. And conversely, from the buyer's perspective, that the price that they're paying for that said intangible is actually going to create a greater value for them as part of their ecosystem, right? So these are, again, things that you need to also justify besides just this is the price, right? And finally, there are instances when you deal with, especially when you're dealing with startups, right? And it's a very exciting time in Saudi where you have a lot of companies in the tech space that are starting up. And, Mr. Hundt has spoken about this numerous times. And you sometimes have restructuring that's happening to a business that is in its very startup phase, right? And part of that, you are moving intellectual property or intangible or software platform, something that has not yet doesn't have commercial shape, right? Like you are still dealing with something that is ambiguous in terms of its commercial utility, right? But as part of the restructuring, you need to come up for the price for this, whatever intangible you're dealing with, whose value is uncertain, right? And if you're using an income-based method, for example, and there is certain projections that you might have, and as it tends to be the case, startup companies always have these hockey stick, very optimistic projections, which is very nice, but sometimes the actual experience tends to be different, right? Just because of the nature of the risk that's involved here. And Zatka has also said that, when you're dealing with these highly uncertain intangibles, right? When you're dealing with some fledgling sort of platform that doesn't have commercial utility just yet, or doesn't have a commercial stream just yet, then you need to consider as part of your transaction certain mechanisms, certain clawback mechanisms that will allow you to adjust that transacted value based on the ex ante performance of this intangible and how that particular business plays out, right? So they've encouraged the use of price adjusting mechanisms. For example, I have a certain IP. I think this, software is going to do really well, and I have these very ambitious projections. And based on that, I've come up with a value, and that value is used to, transact between company A and company B. But as it happens, some macroeconomic factor happens that, all of a sudden, the projected performance is not, what it was thought to be. And as a result of that, the value is much less now, right? So what Zatka is suggesting is that as part of your transaction contract, you need to have elements in that will allow the buyer to recoup some of the price if the underlying asset has not performed based on expectations, right? And this is something that the OECD also endorses, especially when you're dealing with speculative intangibles. And this is something that Zatka has also endorsed, right? Which is very nice to see, and I think that's a good approach. Just coming back to the income method, I mean, Zatka has also commented briefly that there's a lot of assumptions that go into the income method. So you're looking at basically an income stream, and you're looking at certain growth trajectories, certain terminal values, a discount rate which actually reflects the underlying risk of this income stream attributable to its intangible asset. And I'm going to just loop in my colleague Stefan here, who has done 1 million of these valuations over the course of his career, and some of the issues that he has seen with respect to the estimation, the discount rate, and the terminal growth rate, which is his favorite topic, actually.
No, thank you, Samad. Stefan, the floor is yours.
Yeah. Samad, thank you very much. That was really excellent. Maybe just adding a couple of points to the DCF method for tangibles which sit within the wider valuation of the company. Startups always very difficult. You mentioned the hockey stick, but mid-size, large-size companies, there's always the surprise when we look into the intangible DCF approach. We need to look at the wider corporation, how that sits within, and very, very often we'll have the discussion about revenue recognition, about the cost basis, the cost setup, the CapEx, OpEx picture of the company, and using that intangible valuation technique or the valuation of intangibles. There's always a lot of value having discussions with on the accounting side, the finance departments, of how they value the actual company. So what we quite often do, and what the value is, looking in the tangibles, but then just widen that and looking into how does the overall corporation and how does specifics around that as being valued. And you mentioned discount rate.
Challenging them on the forecast, right? Because a lot of the times the forecasts seem to defy laws of economics. And I think as part of that transfer pricing exercise, I mean, a lot of people will say, okay, this is the projection you gave me. I'm just going to use it to come up with a value. But what Stefan and I have started doing is actually holding them accountable, right? Saying, okay, how are your revenues going like this and your cost is flat, right? It doesn't make any sense, right? So things like that, right? That you need to be careful of when you're applying these techniques. Anyways, back to you.
100%, 100% aligned. And we do see the value, and our clients, our partners see the value as well, because it's just another data point or data points to see, is your budgeting, is your business plan, is your forecast relevant? Anand, back to you.
No, perfect. We are in a world of so many different business models, and then the models change. And once it gets digital, it gets more interesting. So again, every founder has its own valuation. So I think it's just important perspective to look at it and see the realistic options. And again, also balancing the tax part of it ideally. So I think that is where the synergy we bring in. I think we are going to culminate now into our final, slide in terms of we have discussed on specific sections across on different topics, but ultimately all these cut through across different sectors and different industries. I'll put some high-level thoughts onto each sector, and then I'll leave the floor. I know that we have the last 8 to 9 minutes. From a manufacturing, again, day in and day out, whenever we do the issues that we have seen is contract versus toll versus full-fledged. Again, from a Saudi Kingdom perspective, we need to clearly understand the functions. Who is doing production planning, who is doing procurement control, who is doing quality supervision, who is doing capacity management. Again, it's all about exercise control over economically significant risks. If such risk control and operational decisions reside locally within the Saudi, then it's always the graph. The more higher the risk, you're looking at full-fledged, then it reduces, you're looking at the contract, then further it reduces, you're looking at the toll. So I think every time we discuss this, always the tax authority put on that hat and see what in-country value you are creating there, and then based on the risk they need to understand, and then the more and more audits that we see in manufacturing is on that reflection. And the second point also have seen is the capacity utilization. Again, it's a very critical factor. Sometimes you go through, even during COVID, we have seen the underutilized facilities when you're setting up companies. So I think these ultimately, you know the business as a owner, as a company, you understand the business. I think you need to get that information, your story, as part of that story to the tax, so the tax authorities do understand where you're coming in and then what actually happened. It's just more to do with the substance. Again, coming to the distribution, it's about the commercial authority and asset intensity, and also obviously market incentive, how much marketing cost that you have incurred locally, and are we just a reseller? You're not adding any value to the product, or are you adding something locally to the product? Are you also doing the sales support? Are you also have a real good marketing function? Are you creating a local marketing intangible? So I think underlying all of these aspects is, if you just do a reselling and there's no value added, you're looking at a gross profit margin. But if you kind of add value, and then again, you need to delineate each of these value additions and see how that impacts your profitability, and then where the risk and location, especially, are you taking the inventory risk or the goods are directly flowing to the client? I think these are the aspects we need to dwell. That is where the tax authority is more interested when you write your function analysis that you are looking at. And moving on to the construction, oil and gas, EPC and construction, again, the issues that we have seen is large infrastructure projects, especially for Kingdom, where the project can disrupt entity profitability level because they can run for 3 years to 5 years. So you need to clearly understand from that tax year perspective, what are the impacts? Maybe sometimes you might have a cost just incurring in the first few years, and then you might actually hit some profitability or revenue in the next years. How are we looking at from a transfer pricing perspective? Are we able to do an aggregated T&M analysis for this, or Do we need to look at a contract specific analysis of that particular project? So I think these are the ones that we've seen. And then again, in the Middle East, we have considerably seen the cross-border deployment of heavy equipment and also a lot of leasing of assets between related parties. How are we looking at it? Who is bearing that? Whether the depreciation is exactly considered in these kinds of huge EPC contracts. I think these are, I would say, the contractual risk and the cost overruns, any penalties, the performance guarantees. I think these are the transfer pricing aspects day in and day out when we are analyzing that we have seen. Moving on to the oil and gas and energy, again, you need to look at the multiple service streams, and I'm sure like my colleagues can also add, are we looking at just the drilling maintenance or are we looking at the full-fledged? Again, we need to clearly understand in terms of the safety, in terms of the functional segmentation for all of these activities, make sure that the relevant remuneration is done. And also we have seen certain preferences of JATCA over the years on the entity level TNMM. And the next one, we're looking at technology and cloud. Again, intangibles always comes in. So how are we looking at it? Whether the entity is actually developing the kingdom entity is developing the value in terms of the DEMPE, or it's only providing the funding, or it is just doing local maintenance and support. I think in the value chain, we need to clearly understand to clearly see the remuneration model, whether I need to get a license fee on the revenue or I just need to get a cost plus model for what I have done. And finally, moving on to the financial and treasury services, I think enough has been spoken from Sarmad. I will only put it this way. Ultimately, you need to look at both from a borrower and lender perspective. From a lender perspective, I need to understand where the money is coming from. And from a borrower perspective, I need to see what are the best options from a rated party or a third party. And then also looking at what kind of credit trading that needs to be taken. And again, over and over that we have seen guarantee, which already Sarmad spoke about, whether really you need to pay a guarantee fee. And then we have also seen a lot of cash pooling models. I might call cash pooling, but within the GCC, it's mostly money movement. So again, whether we bring into the transfer pricing framework, just to look at it, whether there's interest that needs to be appropriately marked up there or not required, and is there even a cash pooling manager who looks after the leader, who looks after the whole entity. So the treasury function, which is also mostly not really looked at from a transfer pricing documentation. I know the paucity of time that we have, and we have like last 3 minutes. But for us, is just to put through these thoughts for you in an overall framework, and then I would just leave the floor. I'm planning to give a minute to Sarmad, Praneeth, and Stefan, and then of course final remarks for Mr. Hundt. Sarmad.
I think I will yield the floor. I've already said too much, but I think the idea is that there needs to be a certain amount of discipline in your transfer pricing when it comes to loans, guarantees, and intellectual property. Right. So I'll just say that as a parting message.
Thanks, Praneeth.
Yeah, thanks, Armand and Anand. I think you've touched upon the industry-specific TP issues. But again, the seriousness from the taxpayers to act upon this generally not comes from the compliance burden, but the TP audit exposure. So based on our TP audit experience in KSA and also almost 30 plus jurisdictions, I just want to list down basics or checklist of documents because we have April 30th fast approaching deadline for the year-end compliances. So it's important to have a transferring policy, intercompany agreements, invoices, TP workings as a backup to those invoices, cost allocation workings, and then your third-party comparables or internal comparables, including valuation reports, audit defense documentation, more importantly, it could be need benefit documentation. And then at the end of the day, look at the applicability for the transfer pricing compliance obligations, see the due dates and ensure that we are fully compliant because non-compliance in a first place could be viewed negatively by ZATCA. So with that, I just want to conclude from my side. Yeah.
Thanks, Pranit. I think, Stefan, you have like 30 seconds on a lighter note.
On a lighter note that um, taxes will go up, more taxes will be implemented, more tax audits will come. There's clearly a move within the GCC, within KSA, to have a more Western, Eastern tax picture. So definitely more work will come towards the finance departments, the tax advisors, anyone involved in taxation.
And thank you, Stefan. And then Mr. Hundt, your final remarks, please.
Thank you so much. Yes, that's very great insights, and we see I can see that the hotspots are turning around. The intangibles, of course, but of course the financial services. And as an outlook into the future, we might look, of course, at Saudi Arabia doing the Pillar 2 integration in the future with the globe rules and so on. This might bring, of course, a lot of news and a lot of new challenges in TP in Saudi Arabia, and a lot of need for great experts like you.
No, thank you, Hunt. I think just for the benefit, this video will be hosted on YouTube as well, and then on the LinkedIn, we will share all the slides. I know we are in the faggot, so I just wanted to update you on that, and then we will also be hosting more webinars. So please keep tuned, and then we look forward to catching up, everyone. Thank you. Have a wonderful evening, guys. Take care. Bye bye.
Thank you, guys.